doesn't quite capture the scale of it. You need a way to create this massive incentive to generate truly huge returns, and that is exactly what carried interest was designed to do. So here's how we're going to tackle this. First, we'll get a solid definition of what carried interest is and, figure out its weird name. Then we're going to follow the money through a process they call the waterfall. After that, we'll get into the two competing ways to calculate it, and finally, we'll talk about the safety net that protects investors, something called a clawback.
All right, first up, let's get right to the core of it. The funny thing is, the key to understanding this whole concept is actually hiding in plain sight, right there in its strange-sounding name.
Okay, so here's the official definition. It's a share of the fund's profits that goes to the manager. Simple enough, but the crucial part, the detail that makes all the difference, is that it's structured as a capital gain, not as a simple performance fee. And trust me, that structure is everything.
And the name itself gives us the two big clues. Let's break it down. First, you've got carried. This just means that the investors, who we call limited partners or LPs, are literally carrying the manager's financial stake in the fund. And then there's interest. This doesn't mean interest on a loan. It refers to the manager's ownership interest in the partnership, their slice of the pie. Put them together and you get carried interest.
So why go through all this trouble? Why not just call it a bonus and be done with it? Well, the answer comes down to one word: taxes. A simple performance fee, that gets taxed as regular income, usually at the highest possible rate. But by structuring it as carried interest, it's treated as a capital gain, just like profit from a long-term investment. And in most places, that means it's taxed at a much, much lower rate. That clever bit of financial engineering is the multi-million-dollar secret right there.
Okay, so we get the what and the why, but how does the money actually flow from the fund's profits into the manager's pocket? Well, that process is governed by a super strict set of rules called the distribution waterfall.
There's a really great analogy to help picture this. Just imagine all the money made from selling the fund's investments gets collected into one giant bucket. The waterfall is the strict, pre-agreed sequence of steps that decides how that money gets poured out of the bucket, and crucially, who gets paid and when. And this waterfall has a very strict hierarchy. First things first, as you see in step 1, investors get all of their initial money back, period. Step 2, those same investors receive what's called their preferred return. It's a minimum profit they were promised, usually around 8%. Only after all that happens, in step 3, does the manager, or general partner, the GP, get to catch up and take a big slice of the profits. And finally, step 4, whatever is left over is split, usually 80% for the investors and 20% for the GP. That 20%, that is the carried interest.
But here's the twist. Not all waterfalls are built the same way. There are actually two main philosophies for how to calculate all this. And as this spectrum shows, they really represent a fundamental choice between giving early rewards to the manager on one side and ensuring long-term security for the investors on the other.
So let's start on the aggressive, manager-friendly end of that spectrum, what's called the deal-by-deal model. Okay, so this model, which was historically super common in the US, calculates that whole waterfall process for each individual investment as it gets sold. The big advantage for the manager is that if they get an early win, they can get paid their carry very, very early in the fund's life. But, and this is a big but, this creates a significant risk for the investors, which is exactly why it's often labeled LP unfriendly.
Let's look at this example to see what that means. The manager puts $100 million into an investment, and a few years later, it pays off with $24 million in profit. Under the deal-by-deal model, the manager can immediately take their 20% carry on that profit. That's $4.8 million, even if every single other investment in the fund is tanking. They get paid right now and worry about the total fund performance later.
So what's the alternative to that really aggressive approach? Let's flip over to the other end of the spectrum, the much more conservative whole-of-fund model.
This model is often called the European style, and it's the one that major investor groups like ILPA really push for. The logic here is pretty simple. Carry is calculated based on the performance of the entire fund portfolio, not just one-off deals. This forces the manager to wait much, much longer to see a payout, but it drastically reduces the risk for the investors.
This calculation really shows you just how much higher the bar is. I mean, look at these numbers. Before the manager gets a single dollar of carry, they have to return the entire $100 million of investor capital plus the full preferred return of over $26 million. Only after every investor is made whole across the entire fund does the manager's 20% carry even start to get calculated. It's a whole different ballgame. Now, we've mentioned this risk a few times, especially with that deal-by-deal model. So what happens when a manager gets paid a huge sum for an early win, but then the rest of the fund just completely tanks? This is where a crucial safety mechanism for investors comes into play: the clawback.
A clawback is pretty much exactly what it sounds like. It's a contractual obligation for the fund manager to literally give back carried interest that they've already been paid. If those early successes are wiped out by later losses, and the fund as a whole fails to clear its performance hurdles by the end of its life, the investors can claw back those payouts that were made too early.
And this right here is the fundamental tension. The entire debate between these two models really boils down to this one simple trade-off. How much clawback risk are the manager and the investors willing to live with? One model is all about getting the manager paid early. The other is all about protecting the investor's overall return.
This table just lays it all out side by side. The deal-by-deal model is faster, it favors the general partner, but it comes with high clawback risk because it focuses on individual deals. Whole of fund is slower, it favors the limited partner, has very low clawback risk, and it looks at the entire portfolio. It's really a clear choice between two very different financial philosophies.
And that brings us to our final and I think most critical question. While that aggressive deal-by-deal model was common for a long time, powerful investor groups are really pushing the industry towards the safer whole-of-fund standard. So, as we look to the future, in a world that's demanding more financial scrutiny and more investor protection, which model do you think will ultimately win out? The one that pays faster or the one that pays safer?